Welcome back to the deep dive. Today we're talking about something that, on the surface, sounds a little dry,
Regulation.
regulation, but it's actually the invisible architecture keeping the whole financial world from, well, collapsing.
It is, and when you really dig into the source material here, specifically Chapter 2 of the Securities Industry Essentials, you see it's actually a high-stakes ecosystem.
Yeah, it's basically a massive game of cops and robbers with trillions of dollars at play.
Exactly.
So our mission today is to decode what they call the regulatory pyramid.
Yeah, you can think of it like a four-tier layer cake.
Okay, so what are the layers?
At the very bottom, you have a firm's own internal rules. Then you have state laws.
The house rules.
Right. Above that, you have the SROs, the self-regulatory organizations. And at the very top, federal laws passed by Congress,
And sitting on top of that whole cake is the SEC.
the Securities and Exchange Commission, the apex predator, for sure. But there's a nuance here that people often miss. The SEC is a civil agency.
Right.
So they can fine you, they can ban you from the industry forever, but they can't, put you in handcuffs.
Right. So if they find actual criminal fraud, they have to hand that file over to the Department of Justice.
Precisely. The SEC sues, the DOJ prosecutes.
You know, down at the state level, you mentioned those blue sky laws. I love that term.
It's very descriptive. It comes from the early 1900s, stopping scammers from selling you, building lots in the blue sky.
Basically selling nothing.
Exactly.
Yeah.
But the real heavy lifting happens at the federal level with the two big pillars.
The Act of 33 and the Act of 34.
And the easiest way to keep them straight is to think paper versus people.
Okay, so the Securities Act of 1933 is the Paper Act.
That's the one. It regulates the primary market, new IPOs, new stock issues.
And the paper itself.
It forces companies to show their hand through a prospectus so you know what you're buying.
Which leaves the 1934 Act as the People Act.
Yep, that covers the secondary market where you and I actually trade stocks. It created the SEC to police the people.
And it gave the Federal Reserve power over credit, right?
Right. Specifically margin requirements under Regulation T.
You know, speaking of rules that affect people, there's the Telephone Consumer Protection Act of 91.
The dinner time rule.
That cold callers can only ring you between 8 a.m. and 9 p.m.
And crucially, that's the prospect's local time, not the caller's.
Let's pivot to the safety nets. This is where I think a lot of investors get confused or maybe overconfident.
Oh, absolutely.
You see SIPC on a brokerage website and you just assume it's the same thing as the FDIC at your bank.
And that is a really dangerous assumption. They are fundamentally different things.
So break it down, FDIC.
FDIC is simple. It protects your bank deposits up to $250,000 if the bank fails. Your cash is safe.
And SIPC.
The Securities Investor Protection Corporation, or SIPC, has zero sympathy if you just make a bad trade and lose money.
It's not investment insurance.
Not at all.
Yeah.
It only kicks in if your broker-dealer goes bust, insolvency. If the firm collapses and your assets are missing, then SIPC steps in.
But even then, there are caps.
Big caps, up to $500,000 total per customer, but only $250,000 of that can be in cash.
And if you're trading futures or commodities.
You get nothing. Zero coverage. You're completely on your own there.
Okay, so the SEC is the boss, but they can't be everywhere. That's where the SROs come in, like FINRA.
The Financial Industry Regulatory Authority. They're the beat cops of the industry, doing the exams, the day-to-day discipline.
But there's a weird outlier in that world, isn't there? The MSRB.
The Municipal Securities Rulemaking Board.
Mm-hmm.
It's a fascinating contradiction. They write all the rules for the municipal bond market.
But they can't actually enforce them.
Nope. They're a bulldog with no teeth. They have to rely on FINRA or the SEC to act as the muscle and punish anybody who breaks their rules.
So speaking of teeth, let's talk about the ones that do bite. The Insider Trading Act of 1988.
Yeah, this was not a minor update. This was the government getting serious after the big scandals of the 80s.
And this is where we get treble damages.
Treble damages, meaning the SEC can sue you for 3 times the profit you made or, and this is key, 3 times the loss you avoided.
It completely changes the risk-reward. A profitable illegal trade could actually bankrupt you.
It turns a small win into a life-changing loss.
You know, when you step back and look at the dates on all these major acts, 1933, 1934, 1970 for SIPA, 1988.
You see a very clear pattern.
It's a reactive system.
Completely.
Yeah.
Almost every single major piece of financial regulation was written in the ashes of a market crash or a huge scandal.
We build the guardrails after the car's already gone off the cliff.
We rarely write the rules before the disaster.
Which leaves us with a final thought for you to chew on.
Mm-hmm.
If regulations are always written looking in the rearview mirror, What's the current blind spot in the market today that's just waiting for the next big act? Thanks for listening to the deep dive.